Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the man, myth, the legend, and someone I treasure talking to each week, Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. How are you today?
Oh man, I'm doing awesome. Every day is Saturday, especially on Monday when I get to talk with you. So that's a lot of fun.
Yeah. We got to think about next Monday. It's 4th of July. So I don't know if you're going to be around or if you're going to do
I'll be
something else.
around. Every day is every day. So
All right, cool.
I'll be here. I actually wanted to talk. So I don't know if you heard, read, or have heard about Jerome Powell's last question at his Q&A after they raised rates 75 basis points. It was about housing, and Powell worked in the word reset, right? Housing needs a reset. That quote has taken on a life of its own. I don't know that everybody, I don't think my opinion of his answer is everyone's. I think everybody is trying to connect Powell's use of the word reset to the Great Reset, right? They're kind of using that vernacular. So did you hear about it? Did you see it? Did you read it?
Yeah, you'll own nothing and be happy. So yeah, the Fed's gonna buy all the houses and rent them back to you.
I guess, yeah, or just give them away, of course.
Yeah. So what is your take on it?
Well, actually, let's bring up a page so we can all talk from the same thing.
Yeah, and I'll tell you what he's saying. So there's two things that he's talking about. One is there's a lot of people have been priced out of the market.
Correct.
But you have to understand what the Fed is doing right now. They want to destroy wealth. They want to destroy demand. You destroy demand by destroying wealth. So housing is overinflated. There's too much equity tied up in houses that could be tapped and flooded into the markets, creating more inflation. So he wants you to feel poor because he wants you to spend less. So that's your stock portfolio, your crypto portfolio, and your house, equity. And that's the biggest gain. There's more equity out there in housing right now than any other aspect of finance. And, more people have more wealth, tied up in their home than anything else right now. That's the average, across the board, average American.
No, you're absolutely right. I actually talked about it once on my daily financial news. I don't remember the exact numbers, but when you look at the stock market wealth, the 1% own like 55% of stocks.
Yeah. And by the way, real estate, not only in this country, but globally is the largest asset class. A lot of people don't realize that. It trumps everything by almost tenfold or something. I don't know.
I think it's 8X. Yeah. I think it's
8X. Yeah. I mean, it's huge.
Yeah. Yeah, totally agree. And again, stocks are predominantly owned by the 1%. If you add in the next 10%, it's like, 90 some odd percent in the top 10%. If you flip to housing, it's far more even, right? The top 10% own about 45% of the equity, which means the bottom 90 own 55%. So you're absolutely right. Housing wealth, far more of a middle-class thing owned by, more and more Americans. And if the average American, again, which is predominantly house wealth, feels poorer, right? That negative wealth effect comes in demand is crushed.
And it doesn't sound logical. Why would you want to destroy somebody's wealth in, this time when things are so expensive and all that? It's because, what I keep telling everybody is, the unchecked outcome, is way worse than just letting the chips fly and letting everything go where it is. So if they don't bring everything back down and reset, values of assets all across the board. You and I have been talking for 2 years now that this asset bubble that's been created by the Fed liquidity and zero interest rate policy is just enormous and has to unwind at some point. So, that's what he needs to do. You got, they first and foremost, they understand they've got to get inflation under control, because if it's left unchecked, it gets into the double digits. And I mean, that'll be way worse than, people's houses, losing a little bit of equity for a couple of years or whatever it is, doing 4 or 5 years worth of, deleveraging, right now in the next 6 months to a year.
Yeah. So again, Powell's comment essentially was, it's right here in the middle. It's still a very tight market, Powell said during last week's remarks to reporters. Prices may keep going up for a while, even a world where rates are up. It's a complicated situation. So this is one of the things that I'm trying to help people understand. And we keep saying that housing moves slower than people want, right? Stocks crash instantly, crypto crashes instantly, right? Housing doesn't move that way. It's one of the things that Powell has done by taking the Fed funds rate and banks taking mortgage rates up. As you know, Greg, they have closed the cash out refi market, right? Refis are down now 76%, right? No, it doesn't make sense to refi. It doesn't make sense. And I don't remember what it was. I think it was like $1 trillion of cash was taken out over the last 2 years via cash out refis and mortgage. That is now off, right? So that lack of liquidity or lack of cash out refi will dent demand across lots of aspects going forward. That's the first thing that he has done already. That's happening right now. Would you agree?
Yeah, yeah, absolutely. And the other thing that's interesting about this whole conversation, like we talked about, I'm looking at the line down below, the affordability, that's a big problem, because now with the median, home price going up and interest rates where they are, people are completely priced out of housing. The biggest thing that they haven't really done is the most dangerous thing that's happening. So everybody's jumping into interest only, arms and things like that right now to bring that payment back in check. Sure. And that still gets you at a decent rate that's keeping things alive. You really need much higher rates. You need 6 and 7s to really bring housing to a complete halt.
Yeah.
You start getting up there where even interest only loans are 5-6%. That will bring housing down. I mean, it almost needs to get back to 8-9% interest rates in order for that to happen. The problem is that happens through the bond market. The bond market doesn't believe the Fed.
No.
So bond rates have been, coming back down because, the market is planning, the bond investors are planning for more of a recession that the Fed is kind of ignoring and, denying, like they did inflation right now. So think about that. They said inflation's not real, it's transitory. They're saying recession is not imminent, it's possible. Before he said, oh, we'll be able to avoid it. Now he's saying, well, it is possible. Next week it's here.
Yeah. Yeah. So this is again why I don't think housing has a huge dent this year, because it moves so much slower. One of my experts on Wednesdays, we talk about adjustable rate mortgages. They're now up to 10%. These adjustable rate mortgages aren't what you and I experienced in the last crisis. The shortest term,
the rates aren't up to 10%, the volume.
Volume, sorry if I miss. Yeah, it's absolutely the volume, right? And it's gone from 2% to 10% of volume. And what I wanted to go with this is that volume or the loan is very different than what you and I experienced last time. Last time they were very short, sometimes 6 months, sometimes a year, the most common being 2 years. Now they're 5, 7s, and 10s, right? So even if ARMs, I'm not saying they'll get there, if ARMs went from 10% of volume to 50% of volume, which we experienced last time, the risk of the reset is 5 years out. We're talking 2027, right? So again, right, you can get ARMs today in the 4s, which historically speaking is still a great rate. So I don't think housing is going to slow down nearly as enough. What is slowing down is the $1 trillion in cash out refi. That is off, gone, not happening. But home buyers, again, just this morning, pending home sales up for the first time in 6 months, still down like 13 or 14% year on year, but up. New home sales, surprise, up last month from the month before. So again, I think people are almost wanting and wishing for this sudden price drop, and it's not going to come, right? This reset that I think Powell was talking about is we have to have a reset of inventory, right? Yeah. Inventory has to grow. Inventory is the answer. Inventory is up now, just reported this morning, 13% year on year. So we're getting there, but we're still in some markets 30, 40% below where we need to be. So this 2022 crash in prices isn't coming. Could it happen next year? Maybe. But with ARMs being in the 4s, no big deal. You got 5 years out, no harm, no foul. Inventory still down. It's just not coming as fast as people want, in my opinion.
Yeah, well, the rates aren't high enough. So, the rates have to go much higher in order for that to happen. And, and let's be clear, when he says reset, he's not talking about inventory. That is what needs to happen. He's talking about affordability. He's talking about price access. First-time buyers are priced out. Move-up buyers are priced out. When he says reset, he's talking about prices. He's not talking about inventory. But you and I know, the only way to affect prices is you got to increase inventory.
Yeah, no, he's absolutely, he's talking about affordability. It's got to be better for first-time home buyers. But there's a series of dominoes that has to happen in order to get there. And oh, by the way, just so we're clear, the other domino could be wage inflation, right? You hold prices flat, you add on 5, 10, 15% of wage inflation. That's another way to get to affordability, right? Affordability is 3 metrics: interest rate, price, and wage. It's those 3 working together.
And, so the interest rate products you're talking about, they have been around. So you could get a 1-year, 3-year, 5-year, 7-year, 10-year interest only, ARMs, all, the 3-1, 7-1, you could get all that back then, even last time. What started that became new last time were like the 6 month, in 1 year,
and neg am, right? We're just throwing the And on the
Yeah,
back
well,
of
you
the
had
loan.
the payment option arms and just all kinds of different exotic loan things. And now you're starting to see a few more of those stuff. Not that one, but you're
Not
starting
that
to
one.
see a
Yeah.
few more pop up.
Yeah.
Balance sheet loans, all these different things, that are out there now for borrowers. And that's where the housing market can start to get a little dangerous. The only thing keeping it, from collapsing right now is that, the mortgages out there that have been originated in the last few years are very healthy versus, 0809. But again, the inventory levels, are the biggest issue. We need more inventory. The only way to get more inventory is raise the interest rates, and then you're just, you're not gonna be able to force people to sell. You just gotta
Exactly.
gotta force people to stop buying. You can't force people to sell.
That is the biggest wrinkle that kind of blows up my mind, because what we're going to experience probably for the next 2 years, because eventually life just takes over. Life will take over and you'll sell, years. But I think there will be one event. Like usually when people move in their starter home, they get married, maybe they have one kid there, they get the second kid, they move to a bigger home, right? They've had some promotions, they've had this, that, the other, they move on. Now, what I think they do is they go out and buy bunk beds, right? They just stay where they are because they're going to look at their mortgage rate. We have, again, this is according to Blatt Knight, 13% of loans have a 2 on it, fixed 30 years. 13, I think it was 38% have a 3 on it. And like 50 some odd percent, below 3.5. So just crazy. People aren't going to move. So we are seeing demand destruction like never before. 18 million people that were qualified at 3 aren't qualified at 6. That's demand destruction. Easy to calculate. What I don't think people realize, and Powell didn't bring this up, but this is what I think is going to cause the problem, is you're going to have a whole wave of people that would normally sell or move up that will choose to stay put. So this wave of inventory is going to be cut in half or more because we don't have forced sellers. They don't have to move, right? They can put 2 kids in a bedroom. They can add square footage. They can do this. They can do that. So I think this wave of supply that everybody's counting on, it's not going to show up. And if it does, it's going to be less and longer out than people think.
Yeah. And there are, new construction units coming, so there's, a number of new construction units that are coming. There's, a few other things like demographics play a huge role in all this, in terms of, people, dying and housing becoming available and things like that, but not like what people had thought. And then of course, all the housing crash people that were, clickbaity housing crash guys. You and I have been talking for 2 years. It's just not possible. There's so much demand out there right now. The only thing that's really going to correct it and correct it quickly is you got to have higher interest rates, and the interest rates are, they backed up a little bit,
Yeah,
so,
they're down actually. They're 5.25 now is the average 30-year from a high of 5.8.
And with these interest only products, it still kind of helps offset that demand, but we are seeing correction. We are seeing, inventories go up, especially this time of year. It starts everywhere. It slows down. We're seeing price reductions. We're seeing days on market go up. We're seeing deals come back on the market.
Yeah.
They're falling out, and you're seeing home builders pull back and all that, but they still have, so yeah, it's going to take some time. And, the only time we've seen rapid, adjustments were, 2009. And that's when you just couldn't, you couldn't give a house away. Nobody could borrow money, but the inventory levels were way different then. So it's going to take as long as it takes this time until you destroy that demand. The only way to do it is through credit controls, where, you don't have all these, exotic loan products and you make it more difficult to borrow, but there's no political will for that because first time buyers and all that. So it's got to be through interest rates and, and then you just got to wait it out. So yeah, it's a very unique time in the housing market, but
so I mean, where do you think, because again, right, you take a 30-year fix to 7%, you probably can still get an ARM at 5.25, something like that, maybe 5.5.
That's kind of what it was, in the 2000s. If you go back and look at rates, from 1990 onward into the 2000s, as rates kept coming down, I think right in there, the 30-year was in the 7s, and you could get that interest only or ARMs, not necessarily interest only, but you could get some adjustable rate mortgages in the 5s.
Yeah, I guess my point is I don't think 5 is enough. Like if you can get a 5-year ARM with a 5 on it, I don't think that's enough. I don't think that causes enough destruction.
Well, I'll tell you, I received a rate sheet this morning, and I'll look at it while we're talking. So, 30-year conforming 5.6, you can get a 15-year at 5%. You can get a 5-year ARM at 4.75, 4.375, a 7.1 at 4.5, a 10.1 at 4.8.
Yeah.
So you're still in the 4s.
Yeah. And we're seeing it. That's why people are doing these ARMs. Are like, hey, people really are betting that the Fed will eventually lower rates and they'll refi into 30-year debt later. That's the bet they're making.
Yeah.
But I don't think, I mean, a 5-year ARM, a 7-year ARM in the fours, I don't think that doesn't cause a housing crash in price. I don't think it does.
No, it doesn't. Some people are afraid of that, but that, like you said, the percentage of mortgage originations, what'd you say? It's at 20% now?
No, 10. It's at 10%.
10%. Yeah. And it's just going to
up
keep
from
going.
2, right? 2 to 10, and then it'll be 15 and 20. And again, what I'm saying is I don't see, I see, activity surprising to the upside. I see median home price going up because, again, I think we've lost the move up buyer. This is the first time since the early 80s we are seeing demand and supply destruction. The Fed broke the housing market. The housing market will not be the same for 2 or 3 years. Sellers who would normally sell aren't going to sell. Buyers who normally buy won't buy. Transactions are going to come down, but I think prices are going to stay higher because sometimes you got to buy. And if you can go get a 5 or a 7 with a 4 on it, 5 or 7-year ARM with a 4, you're going to be like, great, let's go.
Which is still, 4.3. I mean, it's still almost double. I mean, it had gotten down to 2.3 at one point.
No, I've had people reply that they have, 2.5, 2.6, 2.7, 30-year money. But now you're hearing 6s and 7s and you see a rate sheet of 4 3/8. You're like, I'll take it. I mean, that's just what people do.
Yeah, and that's what drove the boom back in 04, 05, because rates were at 4.5 to 5.5% on interest only, and payment option arms, you could get down into the 3s, and that's what drove a lot of the market back then. Of course, the biggest thing was anybody could get a loan, and there was a lot of speculation and all that. Where this is different. This isn't a speculative housing market like it was before.
Yeah, and so again,
there's a few articles out there about hedge funds selling, because of the rates, interest rates, and this and that, and that's going to flood the market. And, I mean, there's just so much demand out there. You could put, another 2 million houses on the market right now and they'd get eaten up. Yeah.
I think there's a couple of cities that might be hurt, if you're the largest owner and you list everything at the same time, but I don't know any hedge funds they're not going to inundate the market and kill their own book. It's just not going to happen.
I mean, these funds are, they're pretty smart, they're pretty sophisticated, and, they know how to do it. I mean, they did it all through 2009 and, backlogging that inventory, the shadow inventory that's out there, and, they'll sit on them, and or give them back to the bank. The bank will sit on them,
Yeah. So the last I heard, we're at 1.1 or I think it was 1.16 million active listings. Rough and tough, I think we need to get back to roughly 2 million. We are clearly adding inventory every week, which is awesome. I don't know, 2 million homes, maybe March of next year, we kind of get there.
I don't know. I mean, at the rate we're going, it's hard to say. It really depends on rates. But you got to get over 2 million homes, for sale to get back to a normal, reasonable, market. And I mean, I remember when average days on market across the country were, 90 to 120 days. And in my market, it was 180 days, my markets.
Yeah. So I think we have a long way to go. It's going to react much slower. There'll be nothing happening this year with price. I mean, as long as you get an ARM with a 4 on it, not going to slow housing.
And we're talking about national averages. Like you said, every market's different. There's markets right now that are really struggling. Inventory stacking up. They can't give stuff away.
Vegas. I had a broker on for Vegas. They added 5% of inventory, like more in 2 days. Yeah. That FOMO is happening big time in Vegas, right?
It's everywhere. You're starting to see houses pop up for sale everywhere because, I don't know what happens or why that happens, but people are like missing the boat. And all of a sudden now I better sell before the market shifts, and the market's already shifted.
Yeah. So for me, Powell's comment is really acknowledgement that he has a lot of work to do. I think I think what he's saying is, folks, I got to get rates higher. I'm going to get rates higher at steps. This is going to take time. I think he raises rates at every meeting the rest of the year. Again, I think he does 3 quarters in July. I think that's a layup, and he does halves or quarters thereafter. I think he has to get rates up. The mortgage rates have to go up. ARMs have to go up. Then you stack up inventory. Then we could talk about, hey, demand or supply exceeds demand, recession, all of that. But that is so next year. It's not coming this year, kind of wrapping this up.
Yeah. And again, it's the bond market. So, the bond market has to change, and, bond yields have to go up, or rates, on that, that 10-year has to go up in order for mortgage rates to really rise. So the Fed can't really affect that. Right now. They don't have any credibility, and that's why the bond market's doing what it's doing. People are, running into the bond market for safety, betting on a recession.
Correct.
The Fed is still denying. So,
yeah. So at this point, I don't think the mortgage rate's going to kill the housing, right? If you can get a 5-7-year ARM with a 4, I don't think that crushes housing. What do you think?
Yeah. It's obviously it hasn't,
Yeah.
so, it's got to be much higher than that. I mean, when you can only get as low as 6, no matter what you do,
Yeah.
and that means regular rates are probably around, 7, 8, 9%.
Yeah.
That's when you would see things change literally overnight.
Yeah. And we're not there. We're a long way from that. I think, would you say conforming was in the 5s, right? I think on
Yeah.
your rate sheet. Yeah. So
Yeah. So,
Yeah.
that's still a great rate. I mean,
Yeah.
that to me, my first, one of my first homes that I bought, my second home, was, the one that I built that was like the dream house, that was the rate. I think I got then. It was like 5 3/4, 5 1/4, something like that.
Yeah. So folks, in video number 2, Greg and I are going to talk about what really causes a crash, a deep, dark drop in prices in a very short order. We both experienced that many times in our careers. But before we do that, Greg, where can people find you?
Yeah, gregdickerson.com. That's where all my info lives. Go check it out.
Awesome. Thanks, buddy.